Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gerdes, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
Welcome, and you do not need to adjust anything. It is true.
Mike is gone.
We got no mic today, so we're actually going to have a good time.
Yeah.
But yeah, it's starting to cool off. It's starting to get a little bit nicer out. There's a lot more activity. Our team, we're seeing a lot of people doing more open houses. But things have gotten a little bit wonky. I mean, we've been seeing interest rates. They've been
Continuing to go up.
They're continuing to go up and putting more strain on the market,
Yeah.
putting more strain on people's ability to get affordable homes, and so we see a lot of creativity in these times, and the ones that aren't being creative, I mean, they're pretty much just weaning themselves out of the market. So we pride ourselves on the fact that we do a lot of creative work, and so that's what we want to talk a little bit about today.
Yeah.
And you've probably heard about us talk about buydowns before, but it occurred to us that we've never really gotten into the weeds.
Broke it down for
Right.
people. Right.
Right.
Because you hear all these things and you're like, what's a 3-2-1 buy down? Or
What does that mean?
what does it mean?
Right, or 2-1 buy down.
Sounds like I'm paying a lot more.
Yeah.
If we're adding all those numbers in there.
So break it down to me. I need to do. I want to play the market, and I'm getting this introduced to me. What? Let's start with the 3-2-1. What is that?
So, I mean, keep in mind, you with a government loan like an FHA or a VA loan, this has got to be paid for by the sellers. A conventional loan, which we have a lot of people going after right now.
So buyers can't do it even if they wanted to.
They couldn't pay for the buy downs themselves.
Okay.
Yeah, the sellers have to pay for it.
Okay.
With a conventional loan, a buyer can pay for the 3-2-1 or the 2-1 buy down or the 1-1 buy down. So let me break that down. So when you hear a 3-2-1 buy down, let's just use a crazy number to begin with, but let's say the interest rate's 8% to start off with.
Okay.
That's the standard going rate right now. So what a 3-2-1 buy down means is the first year the rate is essentially 3% less. So you'd be starting off with a 5%. And then the second year it moves to a 6%. The third year it moves to a 7%. And then the fourth year you go back to your actual note rate of
8%.
the 8%. And what happens is we take these funds and they go into an escrow account that pays the difference in the rate.
So the title company holds onto the funds, or the lender holds.
The lender holds onto the funds. So
Okay.
it goes into a separate escrow account. So typically you have an escrow account to pay for your taxes and insurance as they come due. This separate escrow account is going to pay monthly to the difference in the note rate
Okay.
to buy that rate down. Now, a lot of people be like, well, why would I use this if it's just going into an escrow account to pay? I could keep the
I'm
money
just
in
delaying
my,
the inevitable.
Yeah.
Right.
It's a comfort thing. It's keeping it there. But the cool part about it is it doesn't go to waste. So let's say you're doing the 3-2-1 buy down. The first year it's saving you this is on a $400,000 loan. Okay. It saves you in payments $9,449.16 per month. Excuse me, for the year.
Yeah.
And the monthly savings on that is $787.43.
And that's significant.
That's significant. So let's say that after this first year, the rates drop down and you have all this money left in this escrow account and you want to refinance because the rates are lower than what your note rate is, and it's comfortable for you to refinance, and you know you're going to get a much lower permanent note rate, right? Well, then you would have basically $10,000 left in that account that would just buy down your principal balance, pay for, and when I say by principal balance, let's say you started off with a $400,000 loan, and after that first year you owed $392,000. They would just subtract $10,000 from that, and you would have 382.
Got it.
And then you could add in your closing costs, and you're not paying anything out of pocket, and you still have a lower note rate. But it's really a comfort thing. And although a lot of people aren't getting the full amount of funds to pay down for the 3-2-1 buy down, consumers are like, I just need, this is what I feel comfortable with. We send them information on what's happening with the market and the statistics, and they're like, even if I can't refinance after 2 years, I'm still comfortable with this, but hopefully I can refinance. So we qualify them off of the original note rate, though, so that we know that they'll be able to continue making the payments even after that goes up.
Right, because we have we're all realistically optimistic about rates getting to a more comfortable place, probably next 18 months, 2 years, or something like that.
Yeah.
Some people are saying even sooner than that. But
a lot of people are saying much sooner, but
I'm not with. I don't know.
I don't buy it either.
I mean, I just see so many people spending so much money that I just don't feel like they're going to let off the gas on that until people really start getting skinnier, right? And they're just not.
Well, we just had Jamie Dimon come out about 2 weeks ago and said he thinks there's a good chance that the Feds could raise the rates another 1.5%.
Jesus.
But if they did something like that, that would surely slow people's spending down, and I think it would help to speed up our recovery time rather than these little adjustments. Like, let's just get it over with. Let's rip this Band-Aid off and go.
I'm saying, man. I mean, like, I appreciate it as an investor. I like it because we're seeing a lot more deals, and with like with this, we just had a client going through a builder, and they were offering as part of their incentive because it costs basically 6% in order to buy into the 3-2-1 buy down.
No, it's like 4. It's for the 3-2-1. It's like 4.25%. But we just use those extra funds to pay for closing costs for him.
Sweet, yeah.
And he was super happy.
Yeah. So for him, he got to for them, the builder's lender, they couldn't get him qualified because they had
good for me.
Yeah, good for you. They had kids at the helm of that and didn't quite understand.
But they didn't even offer him the 3-2-1.
They didn't even offer it, and so I guess one of the messages of today is that if you are out there and you're dealing with a builder and they're trying to give you those linear options where they're saying, hey, you're only going to get this or that, have the discussion with them whether or not they have that type of program out there, because our investors and myself as well, I'm using these types of programs to position myself because I know that, I guess I don't know, but I'm playing the market that
we have to,
that the rates are going to get better here in the next 2 years, so I can use that 3-2-1 buy down and then refinance and then use the leftover funds to basically pay for my refinance.
And and it's brilliant. So this is what a lot of people are trying to do to combat the market, and I think our listeners need to think about this a little bit. But a lot of people are trying to get people to do massive permanent buy downs. And keep in mind, when you're doing a massive permanent buy down or just even a permanent buy down, the moment that you close that loan, that money is gone.
Right.
If you refinance in 12 months later, I guarantee you didn't recoup the cost of that permanent buy down. And unless you did a small permanent buy down where your recoup time was 10 months for the difference of the standard rate to the buy down rate. But these temporary buy downs allow you to get that money back. And it's an instant recoup of your funds.
Let's talk about I know we're talking about temporary buy downs, but let's talk about the permanent buy downs for just a second, because I always see like these thresholds where it's like, because I want to know what my break even point is. So if I'm going to buy down my rate and I'm going to pay a point in order to get a 0.5 point improvement or a 1/4 point improvement, what is my break even point? And then when does it stop making sense for me to buy down my rate?
So it's scenario by scenario. It's not like something that I could easily give you that calculation. But what you want to do is you want to take the amount of money that you're spending for that buy down, and the difference between the no buy down rate and the rate that you're getting with the buy down, and what's that cost savings? So let's say it's $100, right? But let's say it costs you $3,000 to buy that rate down 0.5% to get that $100 savings. Well, what's a 3,000.
30 months.
It's 30 months.
Okay.
It's 30 months. It's and
2.5 years, right?
right.
Okay.
So it's an easy way to see what your recoup time is, and kind of pay attention to what you think, or get your advice from your wealth manager or your lender on when they think rates will turn. But be careful where you're getting your information from. You know, don't get your information from mom and dad or uncle that bought a house 2 years ago, because things are a lot different, and they may have not have been through a market and owned a home in that period of time. So I'm not a huge fan of the permanent buy down, although a lot of people are just doing it because it's a comfort feeling in knowing that, okay, I don't have to wait 3 years to get to that note rate. I know that my payment's always going to be this.
Right.
And so I get that.
But it's a diminishing scale, though, isn't
Correct.
it? So, like, I might pay 1 point to get a half a point improvement. For
You're
that,
probably going to pay
for
a
that-
point to get 1/4%.
Okay.
Yeah.
And so if I pay 2, it doesn't necessarily mean that I'm going to get another 1/4 point, though.
Correct.
Does it?
No.
So it's a diminishing scale. So
And it jumps all over the place all the time.
right. So when we're doing the math on these things, we're usually seeing a point to like on our settlement statements. I don't usually see anyone paying down more than like 1.5 points.
It's very rare. Sometimes you get people that want that Ferrari rate, and
Yeah.
that's what we call it. And they're going full bore. I want 3-point buy down, and they just want to say that they got this rate right now.
Okay.
But typically those recoup times are just out of this world. They're much higher than what you would think they would be, and I'm talking like 6 years.
Yeah.
Sometimes that we see those recoup times.
And so I just and I know that we haven't done any call to action, but if you're interested in any of this stuff, please text the word buy down to 623 AZ Recon. Buy down to 623 AZ Recon. We only got a couple more moments here to wrap this thing up, but what else should we be looking for? Because for me, I don't want to do anything that's going to hit any more than 2 years, because I'm going to refinance in 2 years. So if I'm going to put money in the middle, I better be making it or breaking even before that 2 years. Is there anything else to add to that?
No, and that's what I would personally do myself. And I feel like even 2 years it's comforting for 2 years, but I feel like 2 years is a little bit longer than what I would want to do personally. Because even if let's say even if you get to the 1 year point, and it only takes another 4 months for the rates to drop, I'd rather pay that extra funds monthly rather than, you know, having my recoup time be 2 years and then refinance at 14 months or 16 months, because the money's gone.
Yeah.
You know, I want to be efficient with my money and pay less to the investors than what I need to. You know, I don't want to pay them any
more than you have
not
to.
one more penny than I have to. Exactly. So this is why I'm such a big believer in the buy down, temporary buy down.
It's a great strategy, and there's not a lot of people out there that can have these types of conversations. But we'd love to get in touch with you and talk more strategy on the financial side. Go ahead and text the word buy down to 623 AZ Recon.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623 AZ Recon.